Hello everyone, this is Jake from Guzzler Reviews, and today we have a really technical topic, but an interesting one. Thank you all so much for sticking with us through this situation. We are ready to get back to filming to new car reviews as soon as it is safe to do so. So thank you all so much for sticking around with us and supporting us. We love talking with you all in the comments. So thank you, we have a lot planned. Now, it's a little windy, so let's get in the car and talk about why oil has gone negative. Now, I picked this topic for reasons other than just how close it is to our name of gas guzzlers. I picked it because it's really interesting and involves billions of dollars, huge markets, international politics, but at the end of the day, it all boils down to what we love here at Gas Guzzlers, and that is cars, which make up a huge chunk of petroleum consumption. If you have listened to the news recently, you have probably heard about oil. Even if you don't follow the news closely, you surely have noticed the gas prices at your local gas station being so low they make the ratings for the movie Cats look astronomical. Regular gas at the gas station in my area is pretty darn cheap right now, around the low 2s and high 190s. These low gas prices are reflecting the staggering low oil prices right now, with oil prices even going negative on commodity markets for the first time in history. So how does that happen? I mean, negative prices for such a valuable resource just doesn't make sense. Before we move further, it's important to note that oil prices do fluctuate drastically and very quickly. This video is being written on April 21st, 2020 and will probably be posted on April 24th, 2020. So the information is specific to this time, but nonetheless, this is an interesting topic and surely one that will go down in the history books. First, I want to explain what we mean when we say the price of oil went below zero. Now this is a very shortened explanation of commodities trading for the purpose of this video. I'll leave a link to a more detailed explanation in the description if you're interested. Oil falls in a group of items known as tradable commodities. To be a commodity, an item must be relatively uniform in quality and utility regardless of the source. So like soybeans, oil, of course, cows, things like that. In the investing world, you can buy a commodity at a relatively low price and hopefully you'll sell it at a higher price, similar to stocks or financial securities. When you buy a commodity to sell it later, it's called investing directly in the commodity. If you are buying a barrel of oil to sell it later, that is called investing directly in the commodity. You're buying your barrel, you own that barrel, and it is now up to you to sell it. Also similar to stocks, commodities are traded on an exchange, the largest being the New York Mercantile Exchange. Unfortunately, this exchange is not an open-air market where investors run around stepping in cow pies while they try to trade their leaking barrels of crude oil for another investor's bag of soybeans. It's far less exciting than that. It's just a place where a bunch of people in suits trade paper that represents real commodities somewhere else in the world. I'd imagine it looks a little something like this right now. Most traders in commodities are not trading the commodities directly because trading directly means you have to deal with storing all that oil and the logistics related to it. I mean, that's just a pain. Think about the infrastructure you need to store thousands of barrels of oil. Most commodity traders are trading what are called futures. A future is a piece of paper that can be exchanged for some amount of a certain commodity at a future date, in our case oil. The most popular oil future is for 1,000 barrels of oil. These futures are contracts, and they execute on a certain date, usually around the end of the month. When a contract executes, the oil company takes your piece of paper and is contractually obligated to provide you with your 1,000 barrels of oil. Now, most people who trade futures will never see the oil. They simply don't have that infrastructure necessary to store 1,000 barrels of oil. So what do? Well, they sell the contract before it executes. So they have the contract, they bought it earlier in the month, and before the end of the month, they are taking this contract and they are selling it to someone else, hopefully at a higher price. They are never touching that oil. Hopefully, they get the higher price. It is considered very, very bad if you are holding a contract when it executes. This is like trading 101 when you get into commodities. It is very, very bad because now you're stuck with 1,000 barrels of oil. Imagine it as a really expensive and really high stakes game of hot potato. Generally, these contracts get sold to airlines, refineries, or energy companies before executing at the end of the month because those are entities that actually have a use for 1,000 barrels of oil. Unlike your neighbor John, who had no idea what he was doing and is now crying because he's in a house filled to the brim with crude oil. But the problem is, Americans are not driving, flying, or using as much energy because of the coronavirus and related economic slowdown. Demand for gasoline and subsequently oil has dropped dramatically because those big buyers, those airlines, those refineries, they aren't buying as much oil now. A major problem is that production has not slowed down to reflect this huge decline in demand. Countries like Saudi Arabia and Russia are flooding the market with oil. Saudi Arabia and Russia were originally working together to limit oil production in order to raise the price, but after they failed to come to an agreement, Saudi Arabia opened up the taps. Making the supply problem worse, U.S. producers could not afford to stop pumping, as they have taken out huge loans in recent years. Large amounts of those loans were due soon, so U.S. producers had to keep producing at near record high levels in order to make money to pay off those loans. They literally could not afford to stop producing oil. It creates sort of a negative feedback loop. The oil companies have to pump more oil to make the same amount of money with the lower price, but as they pump more, the price of oil continues to fall down, so the cycle just gets more and more violent and crazy. So the problem is, oil is in very, very high supply, but demand is very, very low. And May's future contracts executed at the time of writing this video, meaning if you're stuck with that hot potato as of yesterday, which was April 21st at 2:30 p.m., then you are the proud new owner of 1,000 barrels of crude oil. That means a lot of oil speculators had contracts that were very close to executing, and they had no way of storing that oil if those contracts went through. This led to a huge sell-off. These speculators had to dump these contracts before they executed. And what happens when a lot of people start selling something but few people want it? Prices go down, way down. In this case, the traders couldn't hold on to the contract when it executed, so they had to pay people to get rid of it. Sometimes large institutional investors will be able to step in and buy the stuff if it gets this cheap because they have the infrastructure to store it, but their storage is full. You see, the investors knew that paying people to take the contract and the resulting loss they would take on that contract would be less than the amount it would cost to deal with all that oil they would own if the future was executed while they were holding it. So they looked at the cost of what it would cost to deal with the oil if the future executed, and they looked at the cost of taking a complete loss on their future and in fact paying someone to take it away, and they determined that second option made more financial sense for them. This meant that you could buy an oil contract at a stupidly low price or even get paid to take it. But then at the end of the day, the commodities market would contact you. They'd call you up and say, time to come pick up your oil. It's not even that easy. Most of the oil is actually somewhere out in Oklahoma, and you have to either use a tanker truck or a pipeline to get it. So unfortunately, just because oil prices are negative does not mean that you can just go to the crude oil store down the street and get paid $40 to walk away with a barrel of oil. You see, the problem is not that oil is worthless. The problem is we have nowhere to put it, no one to use it, and people just keep making more of it. An additional problem is that you can't just cork up an oil well and come back to it later. There are many physical challenges associated with this. The oil's under a lot of pressure underground, and stopping it is prohibitively difficult. So even if people agreed to slow production, it would be very difficult. So how will this end? Well, US and Canadian production is slowing. They are closing rigs as they are failing to be able to pay the operating cost. Oil prices have gone so low. Saudi Arabia and Russia have rekindled their relationship and are working on an agreement to limit oil production. And they actually did reach a tentative successful agreement, but was not enough. Goldman Sachs actually called it historic, yet an insufficient cut. These low prices will force continued international cooperation. Remember, many countries depend entirely on oil. Due to the craziness of the commodities trading, compounded by added uncertainty of today's times, it is impossible to tell where oil prices will go next. But one thing is for sure, I will have a big smile on my face when I go to top up my tank. So I hope you all enjoyed that video. I really liked making it. A big thank you to all of our subscribers, as I said in the beginning, for sticking with us through these times. Stay safe, everyone. We're really excited to get to filming again, global pandemic permitting. Have an awesome week, everyone. Let us know if you like these videos like this and the Pontiac documentary, because I might want to continue making them even after we're back to filming normal car reviews. If you like this video and you're not a subscriber, subscribe for weekly car reviews and maybe videos like this. We'll see. And leave a like on this video if you liked it, guys. We'll see you next week. Thank you so much for watching.